Hey everybody, I'm Jonna and welcome to Trading with Master Jack. In today's video we're going to be dealing with the trading plan. The reason why 90% of traders fail is that they all think, trade and gamble the same way. It is what it is. Not many traders last longer than 6 months as they do not understand this game at all. They simply have no trading plan or no desire for putting in the effort to learn or understand trading markets. They do not understand the risks involved with CFDs, spread betting, forex trading, overall risks involved with leverage trading. So what is a trading plan? It is your navigation tool as a trader, your policies and procedures in trading. It essentially sets the boundaries, the do's and don'ts of what you should do within the markets and when you should do it. It consists of these 4 key elements: market direction, area of value, entry position, and exit position, where we deal with stop loss and profit taking. In this video we'll be dealing with part 1, and that will be market direction and area of value. In part 2 we'll deal with entry position and exit position. Number 1, market direction. You got to identify market direction. Is it an uptrend, downtrend, or into a range from an uptrend or into a range from a downtrend? In an uptrend, you'll see the price movement is generally upwards and that it is above the 200 moving average. In that type of situation, you'll want to hold a bullish bias, wanting to open long or buy positions. You'll notice that I use the exponential moving average. I've got the 200 and the red one is the 50 moving average. Depending on your trading style, you might want to use a weighted moving average or even the smooth moving average. It's really up to you. In a downtrend, you'll see price movement moving downwards below the 200 moving average, and then you'll want to hold a bearish bias where you'll be looking to doing short or sell positions. Into a range from an uptrend, you'll see from the uptrend going into a range, sideways trading there, and it's above the 200 moving average, you'll still want to hold a bullish bias, looking for buying opportunities. Into a range from a downtrend, there we go, see the price movement going down into a range, sideways trading there. It's below the 200 moving average. Then you'll still want to hold a bearish bias, looking for short opportunities. Number 2, area of value. You got to identify the area of value. This can be along support and resistance, or along dynamic support and resistance lines, or on trend lines, which also act as dynamic support and resistance. And then we're going to be dealing with wedge formations, ascending and descending triangle formations, which are all classic chart patterns. Starting with support and resistance, you'll see over here you got to plot a support line, and that's where you see where the price movement had found support here, which was also a previous resistance over there, and it had broken through and found support there. And then we've got another support line over here, which was a previous support there as well, and resistance, but now it is a support line in this general area where the price can also pull back to possibly. And we've got another one just over here where support was found over there. And then we've got our latest resistance line over here. This was a sort of a present chart at the time of recording, so this was the highest resistance lines at that stage. As Facebook, this particular asset was trading at the highest levels at that point. Naturally, if you were trading any other asset, you'll need to look at any previous highs along the way, which can act as potential resistance if you wanted to plot additional resistance lines going upward to where the price is. I generally use the daily time frame to plot key support and resistance areas, but of course it also depends on the time frames that you trade on. You can even use the 4 hour to plot it if you're looking at entry positions in the 1 hour. And of course it's important to understand that even though you've got those support lines and resistance lines, this would be an area of value, and that is important to see that you can look for your opportunities within those areas of value on a lower time frame, so that you can find your entry triggers when entering into a position. And this we discuss in part 2 of what is a trading plan. Support and resistance can also be dynamic. we just zoomed in a bit on that chart in the top there, and you can see our resistance and support areas there, forming our areas of value. Here's just an example of dynamics resistance, and there's dynamic support, and then of course dynamic support there again. Moving averages essentially act as dynamic support and resistance as the price moves along, and as a powerful tool to use as well. And this you can also find in trend lines. They also act as dynamic support and resistance. You'll see here's a trend line, and that the price comes into it in its uptrend here. And over here on the downtrend as well, there's a trend line going down, and the price actually generally always coming back into it. And over here as well, another upward trend line, price coming back towards it. And there at the bottom you'll see where there was a strong support, and the price had broken out of the trend line here. And usually when that happens, sure, it could continue downward, but it can also find its support, in which case it did over there, and it then continued on into an uptrend, and that's why there was a new trend line that was formed there. Now we're going to deal with wedge formations. You'll see over here is a wedge formation. This happens when the price consolidation occurs between the upper and the lower dynamic resistance and support of the wedge towards the tip. You'll see there the price going into resistance, down into support, back into resistance, support, resistance, support, and becoming tighter along the way. And this can result in the price going either upward or downwards, and that's common for the symmetrical wedges. It's important to know that the price can go either way, as there's quite a bit of indecision in the market as this price consolidates tighter towards the tip. And then of course you've got to decide on your potential positions to open up in which direction you would consider going. And that would be your dynamic resistance there, dynamic support, looking for your areas of value. Over here, there it is. And then you look for your entry positions. Like over there, for example, would have been a short position going down. Over here, a little bit in the middle of this type of range. Wouldn't be a recommended position nonetheless, but it is one. I actually had this position. It was a trade that I took. I had this bullish engulfing candlestick here, and I had opened up a position just there, and I took profit on top, as you can see over here. I closed my position there. In terms of risk to reward ratio, I had a very good profit range over here, and I was very happy with that. I was planning to, in a sense, go back in the position again if there was a pullback, but it's not always there's never always a pullback when there's a breakout. As you can see then, when I closed my position, when this started going down, I actually the next day after that, it had a stronger move upward, and one could have made quite a bit of more profit, but I had a great deal of reward that I was very happy with nonetheless. Now we're going to look at the ascending triangle formations. See, there's our resistance line, and then we've got our price action moving up there into resistance, and then it moves down into the dynamic support there, and then going back up into resistance, dynamic support once again, back into resistance. So in this typical type of formation, you'll be looking for these conditions where there's higher lows being formed, and then you'll see there's our triangle. Now of course the second condition naturally would be a tighter consolidation of price into resistance. This would allow for a potential break in the upward direction. But this was a present chart at the time, so let's have a look at another example that has a breakout with the ascending triangle. There's our resistance going along. There's a high low, price going into resistance along the dynamic support again, forming another high low. We can already plot a bit of a triangle there. Price goes back into resistance, back into dynamic support, forming another high low. And then you can see already it's starting to form a bit of a range there. And in some cases you might have thought of going into a position over here expecting a potential break upward, and having set a very tight stop loss, you would have been stopped. It would have hit your stop loss there, closing your position. If you had set it further away, it would have most likely, in this situation though, it would have hit it as well. But it's nothing to be discouraged about. It does not invalidate the ascending triangle necessarily, because you can see it is in an upward direction, and even though it broke a bit out of the triangle there, thinking, oh, it could be just a false breakout, you have your stop loss down there, and then you see it returning up against resistance, then you feel confident again, and then you lose your confidence when that breaks down there, possibly even hitting your stop loss. But you can see that the buyers are naturally in control here and push the price back strong, back into resistance. Now, when resistance gets tested a lot, the actual rule of thumb there is that the resistance then becomes weaker. It doesn't get stronger. That was a general misconception. Maybe at one stage a long time ago it was like that, but markets continually evolve and change. So when resistance is continually challenged like this, it can result in a breakout, and that is the general thesis or concept about the ascending triangle or any of the other formations. So then you'll see in this case it had gone back into resistance, into support there again along the dynamic support, forming essentially another higher low in comparison, and then you can see the breakout occurred, and there you can see the full triangle actually forming over there. Here would have been a good entry position actually. That would have been a bullish engulfing pattern, bullish engulfing candlestick to have used there, and that had quite a strong upward trend. Now you can see in this particular example there was also no pullback, so it's often risky to wait for a pullback on the outside of the breakout. That's why it's always good to try to take advantage of it while it is within a tight consolidation in this formation. Got the descending triangle, got our support line just over there. You can see the price actually moving into support, going up, meeting some resistance, into support again, resistance again. Got our resistance line there. This is a bit of a quicker one actually, because there wasn't a lot of consolidation happening in this downward area. This is in a sense all that was really there, and it goes straight down and breaks through. Now the conditions for the descending triangle: lower highs. You can see several were formed here along that whole line there, and there's our descending triangle. Now in this particular example you can see there was a clear false breakout, and that can happen, and it's important to show you these type of scenarios so that you can be more prepared for them. In case you hit a stop loss and the price goes back, then you can in a sense try and get your position back in to catch this downward trend, because at the end of the day, if you did have a position that you opened up here for example and you hit a stop loss here, then it would not be the end of the world if you entered the position again as a short over here somewhere, and you would have definitely made profits back. In summary, we dealt with market direction, where we've got to identify market direction, whether it's in an uptrend, downtrend, or into a range from an uptrend or into a range from a downtrend. And then number two, we dealt with area value, where we had to identify area value, or how to do it along support and resistance, dynamic support and resistance lines, trend lines, and using wedge formations, ascending and descending triangle formations, which is all classic chart patterns. In the second video, part 2 of what is a trading plan, we'll be dealing with entry position and exit position with stop loss and profit taking. And there we'll be going into some good detail where we get some understanding on what's risk and reward, and what risk and reward ratios to use, and how best to utilize your total portfolio. If you enjoyed this video, hit that like and subscribe button so that you don't miss out. Happy trading, and may the trend be with you.